Why is it better for small restaurant chains to band together? Hello, this is Jonathan Mays, editor-in-chief of Restaurant Business, and in this week's episode of A Deeper Dive, I speak with Kelly Roddy, the CEO of the brand platform company Woworks. Woworks operates several restaurant chains, including Saladworks, Garbanzo Mediterranean, Frutta Bowls, Simple Greek, Barberitos, and ZEats. It is one of a growing number of platform companies that collect small restaurant chains. The idea is that these small chains can get stronger buying power than they could alone, and therefore cheaper prices for franchisees. They can also invest in technology and all sorts of other happy stuff. We asked Kelly about how all of that works and whether they actually get this promised savings. We also ask about the market for mergers and acquisitions. Woworks is apparently in the market for a new restaurant chain, and we talk about that, what the M&A market is like, what kinds of companies are looking for, and how those companies would fit in to the rest of the portfolio. We're talking brand collecting on A Deeper Dive, so please check it out. All right, I'm here with Kelly Roddy. Kelly, welcome to the podcast.
Hey, thanks, Jonathan.
All right, so tell us what's going on at Woworks.
Well, Woworks is, we've acquired the brands over the last, since the end of 2020. We've acquired the brands Frutta Bowl, Garbanzo Mediterranean, Fresh. We've acquired Barberitos, Zoop, the Simple Greek. And that over the last 2 or 3 years, we've spent, working on the brands, right? So you have a platform company. The idea of the platform company is to bring efficiencies and buying power to brands that aren't large brands. And so if you look at our portfolio of brands, they are, even though some of the brands have been around a long time, they're still emerging brands, right? The better for you kind of category is still growing, and people are finding their way to that better for you category. And what we were able to do through the platform company is, do a shared service model and give a level of support to small brands that they weren't able to get before. You also get the buying power. So, for example, Barberitos is a great brand, but they have the buying power of 50 restaurants. Now they have the buying power of 400 restaurants. And so in order to make that work, there's a lot of things that have to happen in the background. And so to get the buying power for 400 restaurants, you really have to have everyone on the same technology stack. You have to have everyone doing the same supply chain distributor. You have to have everyone buying product from the same vendors. And once you put those things in place, and it takes a couple of years on a brand to get those things in place, then you really get the efficiencies. And the reason you want to do that, obviously, is you bring the cost down for the franchisees. And with the world of post-COVID cost increases, everything is just in supply chain has gone up in cost. The cost of building out restaurants has gone up. The cost of technology has gone up. The cost of labor has gone up. And so if you're in our business, you're constantly fighting those cost increases. So you really need the efficiencies of, the larger platform company. And so it's been much needed. And quite frankly, it has really helped those franchisees at least mitigate some of those cost increases. And I feel like that we're seeing a momentum shift, and those costs aren't going up as extremely as they were in the past. So those things are leveling out. We're reducing cost and getting more efficient, so it's making it more profitable for the franchisees. So what we've been working on really for the last 2 years post acquisition of Zoop and Barberitos is really just getting all those things in place. So new technology stacks, better storytelling around each of those brands, because these are really better for you brands. They're really healthy brands, and that story is not being told. And so the reason we were attracted to these brands is because the food is clean. When I say clean, I mean no additives or preservatives, and as close to their natural state as possible, right? And so, Barberitos is making all their sauces fresh from scratch. They're making literally everything fresh from scratch. They're not buying bags of cheese. They're literally grating cheese in their restaurants. You just can't get it any fresher than that. And so, but no one knows that story. And so through the brand positioning, we've worked on that. And so we're rolling out that new brand positioning for Barberitos. And so there's something going on in each of the brands, but I think what has been happening is we're getting everyone on this what we call the one wow way of doing things. And once you get that in place, then you can really accelerate the growth of these brands. And we can also, at that point, now that we've built this platform out, we can add new brands to the portfolio. And the reason we would do that is to give us even more buying power, make us even stronger. So,
yeah. So I want to ask about you mentioned the buying power, that you buy a 50, that under Woworks, a 50 unit brand has the buying power of a 400 unit brand. But how much of a difference does that make really? How much are they actually saving because you're able to buy for the full 400? Because usually brands have some very specific menu items that they're that they're buying. And so do they not?
Yeah,
how does that work?
It's a good question. So the answer is it depends, but it's significant. It's really significant, and I can give a few examples. So Zoop sells sandwiches, and they have chicken in their sandwiches. They have chicken in their wraps. They have chicken in their salads. It's a soup company, but they still sell chicken. They sell enough chicken that they're not going to get enough buying power that we would with the amount of chicken we buy through the Mediterranean brands. So the math on the chicken alone is about $300,000 in savings on an annual basis. You divide that times the number of stores, and this is just one item. It's a lot of money, and that's an annual savings from now on. Barberitos has been testing a new chicken. It's also in the range of several $100,000 times 50 units. I mean, you do several $100,000. Let's say it's 300,000. It's actually more than that, but you add 5,000 or 6,000 for one item per restaurant average. That's significant. And so it is in the range of, depending on the brand, 2% to 3% in food cost savings. On the technology side, it's usually a couple of percent of sales and fees. That our contracts are better than they had with, let's say, Uber Eats or DoorDash or Grubhub. We have stronger contracts there. Their distribution costs go down because our contract with Cisco is a much higher volume contract. So it's pretty significant. And then some of the technology stack initiatives. Again, Barberitos is an example. Since we rolled out the new technology stack, their online sales have been up tremendously, and it's a very profitable sell for the franchisee. So it all adds up. It's fairly significant. And in a restaurant, if you can add, and especially in a world of rising costs, if you can add 2 to 3% improvement on $1 million restaurant, I mean, it's significant. So, and it just repeats year after year. And there's always, there are always cost increases, whether it be taxes or rents or labor. There's always, so you're fighting it all the time. So next year there'll have to be another, new initiative and so we're looking at what's next year, and we think we know what some of the key strategies are going to be for this next 12 months that really help drive costs down as well. So. Mm-hmm.
What kind of technology that you have available in a platform company that they, let's say, Garbanzo couldn't have it on its own?
I mean, I think Garbanzo could have the same technology stack, right? I think they could have gone, but they didn't have that stack. And could they have gone, and any one of these brands on their own could have developed that stack, but they didn't. And so for us, if we're going to have 6 brands and grow to 10, 15, maybe even more brands, we also can't have 20 different technology stacks that we manage. And we spent a lot of time developing what this technology stack is going to be and what it's going to look like. And, I've been since I've been in this business, there's a couple of things that are always seem to be a consistent issue for all the restaurants: technology and supply chain. The great thing about our technology stack is it doesn't break. You don't have restaurants losing their registers at lunch. Previous, companies I've worked with, and the horror stories, but I mean, even when we first started with Saladworks, there were registers going down every day somewhere, during lunch, right? And so that just doesn't happen. This system works. It's fully integrated, and but you know what? It's something we don't have to worry about, and it allows the operator to take care of their team and take care of their guests. And so there's nothing in a restaurant more important than the technology working.
Mm-hmm. For the record, we've had some pretty major POS companies go down on a national scale, cause some pretty significant havoc to a certain number of, major POS companies are not immune from outages. I can say that,
right,
for sure.
Yeah,
because we've covered them. So now you are, so now if I understand correctly, you guys are in the market for more. You kind of, you got the company now to a point where you are ready to acquire again. Is that fair?
That's fair to say. Yeah. We feel like, some of the heavy lifting has been done on getting the technology rolled out, getting the rebranding completed. Now there's still some execution things that need to happen throughout the rest of the year, but the plan's in place. It's just executing the plan. And it's in some cases executing that plan for the fifth or sixth time for us. So we know that it's going to work at this point. And so we feel like we have other initiatives in place for all the brands as well, but we feel like we're at a place where now we can digest more brands and do the same thing for other brands. And so we love what we look for is we want fast casual brands. We like franchise brands. So if it's a restaurant, fast casual, franchise, better for you brand, typically appealing to, people who are, so it's not going to be necessarily a value play. We're not going to probably have a dollar menu. And it's going to be going after a guest that appreciates and is willing to pay for a better for you product, right? And so we'd love to see more acai concepts or Mediterranean, which we like, or salad. We believe the juice space and beverage is a huge opportunity for us. And so if it's a category that has tailwinds because, we see that Gen Z and millennials are the dominant purchaser of food now. And so they're more educated about what they're putting into their body, and they look at food as fuel, and they're looking for brands like us. And there'll be, we'll see people transferring out of QSR, fried foods, and going more into a better for you concepts. And so we think, we know that acai, for example, grows at almost 10% a year. Mediterranean's growing at 8 to 10% a year. So we like those categories that the American consumer is gravitating towards. And so those are the categories we want to be in as well. So yeah, we're looking for more brands to add to the portfolio because we want to strengthen our buying power and improve the unit level economics and get the flywheel really turning for these concepts.
Mm-hmm. Are consumers really pushing to healthy items? Because, the fastest growing chains in the United States right now sell fried chicken.
I know. Oh yeah. Absolutely. No, I know. Yeah. But so is Mediterranean. So is acai. I mean, you look at smoothies. So there's double-digit growth in smoothie category. And the difference is chicken category is huge. The acai and smoothie concepts are small, but growing at a high rate. Mediterranean, there's not a ton of them. It's small, but growing at a high rate. And so, all of our categories are growing. The only category that's not growing as a category is Mexican. And Mexican as a category is flat, but burritos as a subcategory is growing still. So.
Yeah.
So it's we say it's a lazy way to look at it because we like categories that have tailwinds that are just sort of naturally growing. Sandwich is declining, burgers are declining. Those categories are stagnant. You're right though, chicken is hot.
Burgers aren't declining. Now look at the numbers. Burgers aren't really declining. They're doing fine. People eat a lot of burgers in the United States.
Yeah.
They do.
I do too.
People eat a lot of burgers in the United States. No, salad, I'll tell you, is a very fast growing brand. So you got companies like Kava, Salad and Go, and companies like that are
there's a lot of good salad concepts out there for sure.
Right. Yeah. But burgers are shifting and stuff like that. But the numbers actually, people eat a lot of burgers. And eat a lot
we see it. I mean, these are enormous categories, right? Mm-hmm. Sandwich and burger, but they're kind of flat. And I think you see, moving. I think you see the market share moving around, for sure.
Yeah. No. And you mentioned the Mexican category, which is actually one of the weirdest. It's actually a very odd category. Not that we necessarily need to talk about it. I could talk about all day about numbers and stuff like this, but the movement within the Mexican category is fascinating because, burritos are one area and then you got tacos, another area, but just broadly full service Mexican is doing terrible on balance. Anyway. But I wanted to ask you a little bit about, so now you said you're still eyeing sort of salads and Mediterranean, but you already have some salad and Mediterranean concepts. How do you balance having, wouldn't you end up having two competitors, or would you rebrand one of the concepts, or what would you do in that scenario?
So I would say that everything's on the table, right? So we believe that. So we've been rebranding Simple Greeks to Garbanzo, and it's worked. And the menus are more similar than they are different. And so I think it really depends on the size of the brand and how strong they are in if it's a regional brand, how strong they are in their region, right? And so we've seen that, like the Einstein playbook, right? Where they were able to buy several small bagel and put them together and create a large brand. And that opportunity still exists. No one's done that really in a while, but it's still there. And I think there's an opportunity, particularly in the acai smoothie market. I mean, you got Jamba and you got Tropical Smoothie and you got some really big players in there. But Smoothie King's huge. But the smaller concepts that really focus less on the smoothies, more on the bowls, there's no one that's huge, right? And so I think there's an opportunity to create a national brand there if the opportunity presents itself.
Mm-hmm. Mm-hmm. Yeah. Yeah. It's, who two brands did a very good job, I think, by per acquisitions and then conversions that you might have heard of. First Watch, for instance, did a great job just acquiring a bunch of brands, a bunch of little brands, and then kind of became the company it is today. Kava did that also, swallowing another large brand, and then they converted it. Right. It's not really a strategy you see very often these days, but it's definitely a strategy and it can work.
There's a playbook for sure.
Yeah. It's definitely an interesting strategy. Yeah. Now, are you looking at anything else beyond what you currently have or anything like that? Are there?
Yeah. I mean, we really we believe there's a big opportunity for better for you pizza for sure. Again, I think you see people, moving around that category as well. And I do think if you can do pizza well and it's a better for you, a dough, particularly in sauces, then I think there's a guess for that for sure. And you can charge a little bit more for that pizza. And, that's a market that, we'd be interested in.
Mm-hmm. Mm-hmm. Now, how are you finding the market for acquisitions right now? Would you consider it robust? Are there a lot of potential targets right now? The M&A markets coming out of the pandemic, well, really since late 2021, have been what I would call substandard, at least for those of us who like writing about acquisitions. They haven't been coming very often. So
Yeah,
how
no,
would you
it's.
consider the market?
I think. I mean, the market's really slow right now. You don't see a lot of transactions. The handful that we have seen are the big ones, right? The huge acquisitions. I believe we still talk to people, right? So we've been talking to people along the way, and there are particularly founder led brands that the founders built the brand to a certain size. Um, they're ready for their exit. They may be at an age where they're ready for an exit, or they may be at a stage in the life of the brand where it's stopped growing, it's stagnant. They're not really sure what to do to get it to the next level. And they're looking, they're trying to figure out what they're going to do. So we're still talking to people. We may talk to someone for a couple of years before they're ready to sell. And so we take a lot of meetings. We talk to a lot of people, and I think we'll see. So I definitely know that where there are brands that are interested. Maybe it's not this year, maybe it'll be next year, and some may be interested now. And so, you talk to a lot of people before you get a deal done, right? So, but we're starting those conversations.
Mm-hmm. One of the issues that we've seen over the last couple of years is sort of this gap between what sellers want to sell their companies for versus what buyers are willing to buy. Because there was a valuation reset in late 2021 and into 2022. Are you still seeing that? I mean, if buyers sort of change their expectations or sellers change their expectations?
I think the sellers have changed their expectations. So the sellers' expectations have always been high. We've gotten and seeing great multiples in the past, and I think some of the particularly founders they have a number in their mind, right? And this is what my company is worth, and without any reason to believe that, other than someone, maybe an investment banker at some point, told them that your business is worth $100 million. But in reality, it's you'd have to get a 40 multiple or something for your business to be worth $100 million. But that's what they think it's worth. And so sometimes it's not a realistic ask. But I think we've seen a bit of particularly the smaller brands getting a little more comfortable with the fact that maybe their business is not worth a double digit multiple these days.
Mm-hmm. Mm-hmm. All right. Now, are there
on the buyer side? I do think that I think that everyone's sort of waiting. You got an election year, you got interest rates that are still high. I think they're on the buying side that there are folks sitting back waiting. What's going to happen with the election? What's going to happen with interest rates? What will that do to multiples? Will we see acceleration of, because franchisees aren't entering the market quite as quickly either because of interest rates as well, build out costs, right?
Mm-hmm. Yeah. Well, I mean, it's a kind of a tough, uncertain market.
Yeah.
And I wouldn't, my perspective is, from what I see a lot of, I don't think that we get quite the private equity interest in this business as we used to. They're still eyeing certain segments, but I mean, there are a lot of private equity firms that have exited this business lately, or in the process of exiting the business. So that sort of well is dried up a little bit. And then I think that gap between, the buyers and the expectations really slowed things down for a while. But I mean, I think the issue today right now is just there's so much uncertainty with this, with the future of the industry. And, we really don't know how the consumer is going to be for the next few months. We're pretty sure they're definitely cutting back. But how long are they going to, is this a cutback that'll last longer because of the economy, or is it basically just a consumer reset, after the pandemic, which is entirely possible, by the way. So I just think there's a lot of uncertainty with the space right now, and it kind of influences the M&A markets.
Yeah, I agree. I mean, we're bullish. Obviously, we believe that, people are going to eat, right? Whether they eat at home or eat out, they're going to eat. So we know that. Will they eat as much? That's on the table, right? Will people eat as much as they have in the past? That is an actual conversation in the industry right now, right? And but we're bullish on the fact that we believe that people in general are communal. They want to be. That's how we entertain ourselves. We go out and have a meal, and we meet people, and we don't want to cook at home as much. And so there's a if you're really interested in demography, you see all kinds of things happen in society where there are more single people that don't cook at home, and there's a lot of really interesting things happen. And then I guess the way we look at it is there's always something, right? There's a housing crisis, or there's a pandemic, or there's high interest rates, or there's an inflation, or there's something always going on in the world. And so, one of my mentors, Russ Umpenauer, used to say, look, back when we were facing the housing crisis, everyone was panicking. He's like, look, Russ has been in the business for a long time. He's like, this is the 50th one of these things I've seen. Don't worry about it. It's focus on the business, focus on great food, taking care of the guest, and all this other stuff is just going to happen. We're going to have crazy presidents. We're going to have good presidents, bad presidents. We're going to have things happen in the economy, but people are still going to be eating. And let's focus on, and maybe not everyone makes it. That's fine too, but the strong will survive, and let's be good at what we do and strong. And he's right. I mean, we flew right through the housing stuff. We managed to get through COVID. Like I said, we're in a great business, and I do agree that private equity is a little skittish in the restaurant business, but that's good. That means we'll get better deals.
Yeah. Well, these are always, it's never a losing bet to just focus on what you can do and not worry about what you can't.
That's right. Because I'm not going to be able to, they're not going to let me adjust interest rates, and they're not going to let me single-handedly select the next president. So, but there's a lot of things I can do, so, to impact the business. So,
right. Kelly, this was fantastic. I really appreciate you joining me this week on the podcast.
Yeah. Thanks, Jonathan.
And that should do it for this week's episode of A Deeper Dive, which was edited, as always, by Spoons. Artwork by Nico Hines. You may find this and other episodes of the podcast on our website at www.restaurantbusinessonline.com/article/deeper-dive. And you may subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays, your host, podcast producer, and the editor-in-chief of Restaurant Business. Thank you for listening.